Hi, Steve Van Metre here, and welcome to your weekly economic update. We take about 30 minutes every Friday to try to make sense of markets that I actually think make sense today for the most part. And I know you're like, that's probably because, Steve, your client positions are up. Yeah, well, that does help, with my change in view. But is the market starting to make sense and react the way I think it should be? Yeah, not entirely, but better than it has been. So today I wrote about the coronavirus. For those of you who say, well, I'm watching a video, Steve, what did you write about? If you go to my website, stevenvanmetre.com, my Facebook page, or my LinkedIn page, you'll see that every week I generally write some form of an article to kind of educate people on the topics that are going on today. I know not everyone watches videos, so I like to write about things. And it may be a little late because I always usually write things the weekend before. And last weekend, I don't think people really understood that the issue with the coronavirus isn't that it's killing people. We have, flus and stuff that do that already. That the issue was it's highly contagious, and you don't see the flu shutting down, air traffic, cities, and all kinds of and businesses and factories. You don't see that. And so I kind of wanted to write about, hey, the real effect of the coronavirus is just slowing down an already slow economy. And there's a lot of issues with that. And probably one of the bigger ones that I see coming is going to be the summer driving season. If we lose vacation travel, the second half of the year for the U.S. economy is done for. It's not going to recover. It just isn't going to happen. So one of my clients said, hey, you should bring back your question and answer sessions, which I completely forgot I used to do. So we're going to do that. So if you have a question, please comment on Facebook. I do look at them. Now, I do have YouTube comments disabled. A lot of that reasoning is I don't like a lot of what people say on when I look at other YouTube videos and see their comments. I don't really care for that, and I don't want to have to police it. So if you're watching this on YouTube, you can either go to my Facebook page and leave a comment on the video or send me an email. I will not promise I'll answer your question or cover the topic that you might want, because I want to be very topical with these videos. I want you to turn these on and watch them like, hey, what's going on right now? So biggest question I've gotten this week is, well, Steve, we own a lot of bonds in our portfolio. Now, for those of you who are kind of, what does that mean? I have what I kind of call my private client group, who were the people that came to me prior to inventing Portfolio Shield, and they're heavy in bonds. And kind of in the last 2 days, those U.S. Treasury bonds, I think, are up blended return like 6% or something like that. Pretty incredible. Don't hold me to that exact return. So the question is, hey, we're up. When are we going to sell? And it's a really great question, because whenever you invest in something, and most people do not do this, but the more money you manage, the more you should be asking yourself this question is, who am I going to sell to? Now, the technical answer is, well, yes, I'm going to sell to a dealer. Okay, who's going to be the counterparty? Who's going to be on the other end of that's going to be dying to buy what I'm selling? And the answer to that question is the retail public, who buys stocks at the highs and sells them at the low. And when they sell them at the low, they buy what is high and rising, which are U.S. Treasury bonds. Now, I've said before, and it's becoming very obvious, that you can make an equity-like return in the Treasury market if you're in it at the right time. And I think we're starting to see that right now. So the question is, when do I want to sell? Well, one, we're not seeing any movement out of retail into bonds. I mean, stocks are still too high. People are still buying. We'll get to that question pretty soon. So the next time you see a big drop in stocks, and I think a big one is coming, and we'll address that in a little bit, that's when I'll be looking to sell. The other factor is you have about 80% of the market is traded by some various form of computer algorithm, momentum, formulas, and they're still heavy in stocks. They've not shifted and bought bonds yet. So no reason to really worry about selling. And the biggest, deepest pocketbook on the planet, the Federal Reserve, is still buying. They're pushing interest rates down. So there's just really no incentive to worry about that. Now, could it be Monday that some of the gains from yesterday and today are pulled back? Sure. But if I told you the Fed bought $7.5 billion worth of US T-bills today that settle on Monday, yeah, you're probably going to guess that isn't going to dip too much or too far, especially since as momentum for bonds keeps going up, guess what all these momentum algorithms start doing? They start picking up positions in that. So no, I'm not really worried about selling that. I think they have a lot higher to go. My original case was 10-year treasuries hit 0 and 30 years hit 1%. I now believe that 10-year treasuries are going to go negative and 30 years could possibly get down to as close to 0. You said, how can that be? Well, it's simple. I mean, you have to factor now the coronavirus is going to keep people from traveling and spending money. And the other factor you have with interest rates is the unemployment rate. When people start losing their job, they don't go buy homes, cars, TVs, borrow money for vacations. And that's what causes interest rates to collapse during recession. So we see weak lending growth. Now, if I thought low interest rates were inflationary, now I don't believe that. Now, there is a point where they are low enough to create inflation, although it's temporary. I would go look at that in the lending data, hence why every Friday we look at the lending data. And guess what we're going to see this week? Yeah, nothing. Last week we saw a jump, but nothing this week. And again, who am I going to sell to? My intention is obviously the retail public who virtually owns no bonds because they've been told don't buy any bonds. To the extent of today, the reason interest rates fell so much is JP Morgan has been telling its clients to short 30-year treasuries, who you can probably guess is buying 30-year treasuries, and some hedge fund is reported that is blowing apart because it was deeply short 30 years as yields fell. Interesting. Who is buying stocks these days? And that is probably corporations that are still buying their shares back, which we can assume that in the months that come will go away, and the retail public. Now you say, well, I thought the real retail public was all in. Yeah, you can also sell your losers and buy more of the big market cap weighted stocks like Apple, Microsoft, Google, Facebook, and whatnot. So you can buy. Because what is the formula that investors have? Simple. Are stocks trading less than their all-time high? I mean, have they fallen? Have stocks dipped? And is the Federal Reserve easing? So right now, are stocks below their all-time high? Yes, they've dipped. Is the Federal Reserve easing? Yes, they have. So if the stocks are off their all-time high and the Fed is easing, then you buy. That's the formula that investors use in bull markets, and that is part of the reason why they always buy at the top. So that's who's been buying. What about the dollar liquidity shortage? Yeah, it's still a problem. The Fed is still running overnight and term repos, and the demand for dollar loans is increasing. Although I thought with if the dollar weakened, which it is, the demand for dollars would go down, and it hasn't. I still think the dollar's got one big rip higher. We'll see. But yes, this is a problem that will not go away until the Fed really kicks in its easing program. So the last question then is, will the Fed cut rates again? I'll add a new bold prediction that will be at 0% by the end of this month. That's a bold prediction. The Fed meets in about 2 weeks, and I think they've got a lot to cut. So let's take a look. I mean, I'm going to show you. I'm not just look. I educate you. I don't just tell you what I think. I'm going to show you why I believe what I believe. So let's get into some of the stuff I've got for you. The NASDAQ McClellan Summation Index, a proxy of market liquidity, that when it breaks down 300, you look at a major sell-off coming. And as on yesterday, it is, which tells us, obviously, investors tried to fight back today at the market close because this is telling us a big sell-off in the market is coming. I believe that. I will give you some other evidence of that. Let's take a look at the lending data. Securities and bank credit surged, looks like $25 billion or $6 billion. Most of it, some of it being mortgage, we're on the wrong line. Mortgage-backed securities went up, $3 billion. But look at this. You've got this huge 27 billion increase, something like that, 26, somewhere right in there. 27 billion increase in non-mortgage debt. These are Treasury securities, bills, notes, and bonds. So as the banks have been telling everyone to short, you should never listen to what they say, but what they do. If you don't think these big players know how the game is played, they do. They tell you to do one thing and they do the opposite. Looking at loans and leases at all commercial banks fell $4 billion. Commercial industrial lending fell a little bit. Virtually it's flat. We're going to look in the data. We're going to see, oh, it looks like it increased a little bit. The back-end data in January, so as we move through the year, this thing is flatlining hard. Real estate loans, flat. Commercial real estate loans up slightly. Consumer loans were up $4 billion, kind of even across the board there. So we do see some activity in consumer lending, but virtually nothing from the big players. And when you get lower interest rates, everyone's like, oh, it's inflationary, it's inflationary. No, it's not inflationary until it is. They have to go low enough to spur lending demand. Did you see lending demand there? No, you didn't. So what does that tell us? Rates are not low enough. And as they go down, they tighten financial conditions. So, well, how can that be? Look, if you were a bank, would you want to lend at 20% or 1%? I'd like to lend at 20, not 1. The more I lend out at 1, the more I got to worry, is that money coming back? Think about it. All right, so here's the fact of the story on the Fed easing. The upper bound of the federal funds rate, keep this in mind, is 1.25%. Everything 10 years and under is under the upper band. 30-year is sitting at 1.297. Now remember, the Fed cut 50 basis points. So 30 years were just under 1.75% earlier this week. Big crash in yields because I said when the Fed cuts, yields will fall. In fact, the Fed sent a speaker out today who said, hey, we think the 10-year treasuries could go to zero if we drop the Fed funds rate to zero. Merry Christmas to me and you, depending on if you're one of my clients. That would be great news. So let's look at the lower bound of the federal funds rate. It's at 1%. So we have 10, 7, 5, 3, 2, 1, 6 month, 3 month, and 1 month, all inverted against the federal funds rate. In fact, even more insulting to the Fed and their inability to manage monetary policy, 6 month yields are below 1 month and 3 months. 1 year is below them. And so is 2 year. Is below the 1 month, 3 years below the 1 month, 5 years below the 1 month, and 7 years is below the 1 month, and so is 10. The Fed has to cut not just 50 basis points, they need to cut 0.75%, and if you're going to do that, you might as well go to zero. There is your evidence on the stupidity of the Fed and what they think that cutting interest rates does. It causes interest rates to go down. And as I said in a video previously this week, the easiest trade you can make when the Fed is in a cutting cycle is to buy a bunch of U.S. Treasuries and do nothing and just wait. We'll look more at that. Into the charts we go. M2 money supply growth rate is flat at 1.734%. 6 month rate of change is flat. 3 month rate of change is flat. Nothing going on here in the money supply of interest. Real estate lending growth flat at 4.23. So we had a big jump over the last week data, but on a year over year rate, we're flat. On a 6 month rate of change, we're flat. On a 3 month rate of change, we're flat. This is despite all the increase in refinance applications. Now keep in mind, when refinance applications go up and purchase applications go down, banks got to buy 30-year bonds to duration match or maturity match, depending on what word you like, same difference, that new refi. Because, if someone's a 20-year in refis, they don't stay at 20 in this market, they're going to go out to 30. So what we're seeing in the lending today is you can have all the applications you want, but until they're approved, they don't mean anything. Keep that in mind. There is a difference between an application and a funded loan. Big one. How about commercial industrial lending? It is up. You go, oh, look, it's up 1.34. Yeah, because the back end data had a dip in it. The 6 month rate of change is negative and falling. 3 month rate of change is rising and flat. There's just no activity here in commercial industrial lending. And bringing it all together, encompassing 1/3 of all lending in the U.S. economy, private lending. Growth rate is flat. Loans and leases at all commercial banks. Growth rate is flat at 4.16%. 6 month rate of change is flat. 3 month rate of change is flat. There's nothing going on here at all. And looking at consumer loans, credit card growth rate flat at 4.47%. Again, no sign of any inflationary lending data. So let me see. Oh, good. We have plenty of time because I want to look at the charts and the technical damage that's going on here. Look at my view that I think volatility is going to go through the roof. I think we're on the cusp of a 2008 style volatility surge, maybe even bigger, Because when you suppress volatility, you can suppress it for a very long time, but the longer you suppress it, you end up creating hyper volatility. Because what happens is so many people get lopsided onto one side of the market, pretty much as we have now, that as they go fleeing to the other side of the market, well, that causes a lot of volatility, and it's all at the hands of the Fed. All at the hands of the Fed. Now, let's go look at some charts and see what interesting things that we can learn. So let's start with the S&P 500, who everybody claimed rate cut, 2 rate cuts was super bullish for stocks. All right, so there's your 5 rate cuts, and here's stock prices below all 3 of them. Here you have all the $60 billion per month of easing the Fed did, and we're effectively marginally higher than when the Fed started it. Actually, I think they started kind of mid-October. So look, stock prices have gone nowhere despite a massive amount of easing. Why is that? Because the Fed easing at this stage is not inflationary until it is. So rates are still too high, even as low as they are. And that is why investors get this wrong, because they're saying, oh, look, stock prices are off the peak. The Fed is easing. I must buy. And if you go back and look at prior cycles, huge mistake. And let me re-illustrate this for anybody who's not seen this before. Because one of the other things I want to mention is the 3-month Treasury yield leads the federal funds rate. So here's the 3-month Treasury yield. Let's zoom out on the weekly chart. I was like, where did it go? There it is. So look, when 3-month yields go down, stock prices go down. 3-month yields go down, stock prices go down. 3-month yields are suggesting, look at this. They are literally suggesting that we are going to have a waterfall collapse in stock prices. You can see every time it makes this big move down, the next thing that comes is a big move down in stocks. And then it hovers a little bit, tries to recover, big move down in stocks. Same here. Big move down in stocks. And this is coming. This, I believe, is coming. And if you overlay this 3-month yields against volatility, the VIX volatility index, you can see when yields go down, volatility goes up. And if we look at volatility, we're sitting close today at 42. Now, you could say that doesn't mean anything to me. What it should mean to you is 42 is about as high as this gets. 42 to 50 is about as high as this gets before you see a reversal in volatility. Its stock prices go up. The Fed is artificially keeping volatility up by buying T-bills to ease financial conditions. This is so absurd that you can't make this stuff up. But here it is right here on a chart for you to see. So what does this tell me? If the market doesn't get this under control and get buyers in to buy stocks to counteract the Fed, we're going to have a volatility explosion as people get unwound from their positions. And the Fed is going to buy this and do this. And you can also look at emerging markets and see when the Fed starts to lower rates. You can see in purple, I'm going to keep my mouse over for a second, that emerging markets crashes. And this kind of shaded bar of doom, when emerging markets get near this thing, volatility explodes. When it crosses through it, game over. You're having like financial crisis or major sell-offs coming. So we know that. Now, how about long-term interest rates? People say, oh, long-term interest rates, they're too low. Nope. As long as the Fed is cutting, look, 3 months go down, long-term rates go down. 3 months go down, long-term rates go down. 3 months go down, long rates go down. Same with the 10-year. There it is. You don't have to be a rocket scientist. You just have to follow what the Fed is doing. That's all you have to do. So looking at VIX, the volatility index, I think we're on the cusp within another week of having a major violent sell-off in this market coming. And when you realize that everyone is positioned heavy in stocks, it's totally believable. And the Fed is going to do it. I've said this. I've written about it. The Fed will ease us into the next recession, and they're going to do it. All right, now let's look at the volatility ETF VXX. Now, you're never going to trade this. And I'm not saying that to suggest that you should trade this. I'm saying you should never trade this. Ever. This is highly speculative. And even someone who knows what they're doing shouldn't even touch this thing. So let's look at this. And now say you can't do technical analysis against this, but here you can see Going back to early 2019, you had people selling volatility, selling volatility, selling volatility. Now, what do they do when they sell volatility? Excuse me. They take the proceeds and they buy stocks. Selling volatility, that's why when volatility falls, stock prices go up. And the selling volatility all through here. And now what's happened, volatility is rising. Why? Due to the Fed driving interest rates down, tightening financial conditions. And volatility got right up here to this roughly 31 price level where we've seen sellers at. And if we zoom in today, you can see it wasn't until late trading they pushed it down to this dotted line. Now, why does this dotted line matter? Because this is where we've seen prior sellers. So the market's trying to say, hey, all you folks that sold in here and shorted volatility in here, are you back in the game? Because if you get a break over this $31 price range, there's not much slowing this down. You're looking at, excuse me, the more I talk, the more I cough, and this thing is almost gone. The more this thing gets up to the 50s, and then it just blasts off from here. Because nobody is long volatility unless you own U.S. Treasury bonds, and we know very few people in the market do that. Let's look at 30-year Treasuries. Excuse me again. Rate cut, rate cut, rate cut. Rate cut, rate cut, boom, yields going down, following the 3-month yields down. Thank you, Federal Reserve, making anybody that owns Treasury bonds a lot of money right now. And if there's any doubt in that, take a look at IEF. This is 7 to 10-year Treasuries up 1%. TLT 20-plus year Treasuries up 5.2%. You know, in one day, people say, you can't make money in bonds. Really? In fact, how about 30-year zero coupon bonds up 8.18%? When's the last time you saw the stock market up 8.18% in a day and knew that it was probably going to keep going up? And you say, well, it can't go up, man. That's, Steve, in this charting pattern, this is where you should be selling. Yeah, if it was a stock chart, yeah, I would agree with that. In a barn chart, you get these surges higher, and boom. I think it's here. Let's look at TLT. You see, you get these big violent moves higher. Boom, 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 boom. And here it could just go vertical. Why is that? Because when markets take off, when bond markets take off because the Fed is easing, here, let's overlay 3-month Treasury yields. Look, when they're going down, people are forced to reposition because the entire market is short bonds. Why is that? Because stock prices and treasuries need to go up together. When they're dislocated and yields are falling and stock prices are rising and the Fed is driving yields down, stock prices have to catch down. They've got a long ways to go. And when you know that nearly most of the market does not own treasury bonds, and we're not seeing mass, rise in unemployment, and guess what? This thing has got a lot of leg left, a lot. Yeah, there may be some dips, but don't worry. The Fed is going to buy these up, and you can see it right here in the data. As yields go down, bond prices are going vertical. It's I told my clients, and I said, look, don't worry about missing out on the equity rally. You can make the same return in bond in a matter of 6 to 8 weeks. Well, there you go. Let's move on to crude oil. Closed at 41.57, somewhere down there. I want to have a little heart-to-heart about crude oil because what I'm going to say is not offensive, but it's very upsetting because I know a lot of people. The oil and gas industry is a major employer where I live. I have a lot of clients that work in the industry or have worked in the industry. So listen to what I'm telling you, please. Oil at 41 a barrel is not inflationary. You go, well, wait a minute, but low oil is, look, there's no demand for it. If you don't believe me, go find someone that you know that works for a small, maybe even a large oil and gas producer, and you go up to and say, hey man, I heard that oil at 41 is inflationary. And they're going to say, yeah, it's so inflationary, this industry is about to have even bigger layoffs than you thought were coming. Because many, maybe most, maybe nearly all small producers are not priced to be profitable at 41 a barrel. They're not. Yeah, the majors can get by. They're going to be cutting too. 41 a barrel is the worst thing for an industry that hires an immense amount of people and pays them well. This is bad news for the economy, very bad news. And on top of this, the Strategic Petroleum Reserve is going to release 15 million barrels of oil this month. I said, well, why is the Trump administration doing such a foolish thing? It didn't actually happen under Trump. This is something that was passed before Trump took office. And on this month of this year, the SPR was scheduled to sell 15 million barrels. You want to talk about bad timing? Yeah. Bad news for the oil and gas industry right here. So let's take a look at this chart because it is ugly. Let's go back further. Maybe I need to go back even more. Here we go. Now, we're at 41 a barrel. We're at major level of support. If it does not hold 41 a barrel, and I doubt it will, the next destination is going to get right down in here into the high 30s. If the people that bought back in 2009 are no longer interested, that will slide all the way down, and it probably will, to $30 a barrel where people last bought in 2016. If they're not interested, the next logical destination is $20 a barrel. You're like, that cannot happen. Look where the last big group of buyers is at, right down here at $20 a barrel. The coronavirus isn't the problem, it's making it worse. So, oil at 20, want to see a lot of layoffs? Yes. And it doesn't help that OPEC today, no cuts. And how did that affect small oil and gas producing stocks? Let's take a look. Where is XOP? Here it is. New all-time lows. Record all-time lows. You want to talk about maybe buying something dirt cheap that you may have to wait a while? This thing, and I'm not saying you should be buying this today. I'm saying wait till this thing gets down to next to nothing. Again, it may take you a while to get your money because the industry is going to have to recover, but these stocks are going to get next to zero because a lot of these companies and this stuff are going to go out of business. Looking at the majors, XLE, which is mostly Chevron and ExxonMobil, I said, once it gets down to here, if it doesn't find buyers at roughly, this $42, $45 range, this thing's headed down here to 30s. And you say this just can't happen. It can. Look at Chevron, down almost 2% today, sitting at 95. Its next destination is going to be down here in its 80s if it can find buyers. From there, you're talking potentially in the 60s, not seen since 2009. And if this coronavirus and the economy persists, the economy continues to slow, there's no end in sight where these stock prices can go without demand. Look at ExxonMobil. The last little bit of buyers was here at 50, broke 47. Its next major destination is $40 a barrel. Not good. This is not good at all. Let's look at some of these other stocks. How about FedEx? Broke its major top. People say, I don't believe in technical analysis. You better. It's shown right here. All these people that bought up here, man, look at this down here at 127. FedEx is headed down to 110. If it's lucky, it'll stop there. If not, you're talking down here in the 90s. How about Boeing? Whoopsie, broke out of this massive top that I said. Remember I said Boeing's in a massive topping pattern. There it is. And when it breaks down here, sayonara, there it goes. And Boeing doesn't have a lot of, it's fishing back to the buyers from 2017. Not a lot there. How about the banking industry? Let's look at small regional banks. Coming back down to their pre-election price levels. Low interest rates are bad for banks. They don't make money at this. When this breaks, there's no doubt in my mind it's going to break 34. Small bank stocks are going to be cheap too. How about big banks? Well, guess what? They don't make a lot of money at. Here, check this out. This is cool. You want to know why bank stocks are going to crash? Overlay 3-month Treasury yields. It's telling you bank stocks are coming down big time. Look at that. Boom. Where do you think they're headed? They're going to crash. Banks don't make money when they lend at 0% interest. I assure you, they don't. So here's the deal. The next week of the market is absolutely critical. The bulls need to get stock prices up. They don't have a choice about this. They need to get them up. If not, this whole thing potentially within another week could start to unwind. And what am I watching for? Well, I know the Fed's going to cut and drive interest rates down, tighten financial conditions, but watch the number of coronavirus infections. If this thing continues to rise through the weekend, and it probably will, I mean, watch Europe, watch the United States. There's nothing that's going to stop this. But if you hold cash, have your portfolio hedged with U.S. Treasuries like I do with the Portfolio Shield algorithm, or you own a lot of Treasuries like my private client group, this is great news. If you're ever one out, well, I guess I could say I'll be buying when you're selling. Anyways, we'll see you Monday to see how hedge fund managers are positioned, and let's hope they're still short treasuries. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. Materials not to be construed as a recognition or solicitation by selling security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in the video that I do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.